Today, we're going to talk about SBA financing and how it's such a great tool for us to get into business and why franchises might make sense for some of us out here. And basically, on a franchise startup, you can finance between 80 to 90% of the startup cost. That's franchise fee, working capital, and so forth. And so we have an SBA directory of approved franchises. And so if it is an established franchise, we look on this directory. And even if it's not, we can usually get them funded anyway. So SBA financing, it's the Small Business Administration. It's a government agency that supports entrepreneurs and small business owners, right? And the SBA guarantees a portion of the loan. They don't make the loans. So who makes the loans? Banks, credit unions, and non-bank licensed SBA lenders. So there's 14 licenses of non-bank SBA lenders, and that number should be growing. And so there's the SBA 7A loan, and that's usually what most people use, and that finances just businesses. It can finance business with real estate. It's the most versatile loan there is. And that's primarily what's going to finance most of the franchises. Now, there's also the SBA 504 loan program, and that is for heavy machinery or real estate. And that's going to be a fixed rate product. It's 2 loans, and people use that because the cost of capital is generally cheaper, and it's a long fixed rate. It's a first and second. The first loan is made from the bank. The second is basically originally made from a bank loan, but then it gets sold off in the secondary market. And that second loan is actually guaranteed. So that right now, the rate on the second SBA piece at the debenture is in the, I believe it's right around 5.7 on a 25-year fix. Now the senior loan varies. So that's the 504. So sometimes we put the 504 with the 7A. But in general, if you understand how these loan products work, they can really help you for working capital, for starting, for expanding. You can do business acquisitions. You can buy a franchise that's already established and somebody's retiring. You can do a franchise startup. You could do a non-franchise startup with SBA financing. Obviously, there's certain criteria for each of these programs. But generally, if you have relatively good credit, you have outside income that supports outside bills, and you have a business model or a business plan that makes sense, whether it's an acquisition or a startup, it's financeable. And that's the beauty of it. And there's tips and tricks as you do business acquisition where you can get the seller to carry some. And generally on a business acquisition, you're looking at about 10% of the total cost as a down payment or an equity injection. So it's really high leverage. There's no other business funding product out there. It's actually in my opinion, it's the best financing tool for business owners. Now, there's certain businesses that are eligible, like it can't be for what they construe as investment. So it couldn't be for you to buy multifamily because that's a passive business. But if it's an active business where it's like you're managing self-storage, that's eligible. That's eligible. So as long as it's like an owner operator type of business, it's eligible whether it's got real estate or not. And if loan amounts are under 500,000, they can do deals with no collateral, meaning they don't look for additional collateral. Loan amounts over 500,000, if you have collateral and there's a collateral shortfall, they will look to put a secondary lien on some of your real estate to make up for that collateral shortfall. Most of the stuff we're talking about today in the franchise space, most of these individuals that are investing into franchises are doing franchise startups, and generally they're anywhere from 80,000 to 500,000 in total project costs. So generally the loan amounts are under 500,000. So just knowing that if you're doing something without real estate and it's over 500,000, there's going to be a collateral shortfall. Now, if you don't own real estate and there's a collateral shortfall, that's okay too, because they can still do the loan. It's almost kind of a shortcoming of the program that if you do have real estate and the loan amount's over 500,000, they will look for additional collateral if there's a shortfall. So that is kind of a little bit, probably too much more information than you need to know at this moment, but just trying to dive into it a little bit. If you go to the next slide, please. So the benefits of SBA financing: lower down payments, 10 to 20% on a franchise startup is the required equity injection. We call it down payment and equity injection in business terms. And generally on a franchise startup, most of the banks want to see post-close liquidity. So if your total project cost for that franchise is $300,000, they want to see after you put your down payment down, they'd want to see about $30,000 liquid in reserves. Not all banks are the same, right? All the banks and lenders, the SBA lenders, they look at the SBA guidelines, which is called the SOP. It's like 1,000 pages. But you can go to one bank and they say, hey, well, we're going to do 70% loan to cost. Another bank will say 90% loan to cost, and we don't care about post-close liquidity because we're building working capital into the loan. And generally, these loans have longer repayment periods than most other kind of conventional business loan product. So this is a 10-year term without real estate. If real estate makes up the majority of the acquisition or the business, you can amortize these loans over 25 years. So these loans are based on Wall Street Journal prime rate, which currently just dropped 0.5% to 8%, plus a margin. Margins generally are from 1 to 2.75, and then your rate typically adjusts with Wall Street Journal prime. So right now, I believe we're going into a market where the rate will keep adjusting down. About 3 years ago, Wall Street Journal prime was somewhere in the 4s, so it doubled. And anyway, when you're looking at these franchises, we're going to build out projections to see what this franchise model could do. We're going to factor in whatever the capital costs are to make sure this business is going to be a profitable business for you. Some of the 7A rates, when they have a real estate component, are better because the banks like real estate deals, and you can see fixed rate options in the 7s right now on real estate deals. So there is a difference and you can also amortize over 25 years. So generally, what's required? So the SBA through the government, they're really trying to promote business ownership. Business ownership obviously helps the economy in a big way. I was just at a conference the other day, and this is pretty fascinating. Let me just pull this up for you because I didn't think I was going to tell you about it, but I just was there, and so I think this is kind of relevant to this conversation today. So give me 1 second, and let me find the slide here. Okay. So 99% of U.S. businesses are small businesses, right? 46% of American workers are employed by SMBs, which are small businesses. 44% of the GDP, the gross domestic product, is made up of small businesses. There's over 34 million small businesses in the U.S. Small businesses produce 13 trillion in gross revenue. 63% plus of new jobs created between 1995 to 2021 were SMBs, small businesses. So as you can see, really the U.S. is really, and most other countries, it's really grown by these small businesses, and that's what we're doing. So kind of like what the trends I believe are going to happen is that more and more people are going to go, hey, look, it's so much better to be a business owner. Why? Because the tax code wasn't really written for W-2 employees. It was written for small business owners. There's a lot of tax advantages. And so that was pretty fascinating. And also, they're predicting in the next 10 years, I think about 12 million new businesses will start. And there's 10 million businesses that I might be switching to 12 and 10 million businesses that will change hands. So all these baby boomers will be selling businesses. So it's really an opportune time to get involved in business ownership, whether a franchise or business acquisition or you have an idea and you do a startup. So what do you need generally for qualifying? So generally, you need a 680 or better credit score. No recent, obviously, bankruptcies or foreclosures. If it's several years past, there are banks that will look at those type of deals. You need a personal financial statement, which is a specific form called Form 413. You need tax returns for yourself for 3 years. A bank statement showing liquidity that you could, if we're talking about a franchise startup, you're going to need your 10 or 20% equity injection or down payment. plus your 10% post-close liquidity, and 3 years of tax returns. Generally, we're gonna have a like short resume and a business plan on what you're gonna do with this franchise. And if you get involved in a franchise, most of them have templates for all this stuff because you're going to create projections. Projections are very important also because now, let's say you're looking at a painting franchise and the all-in investment is $200,000. The bank's going to want to see 3 years of projections, the first 2 years broken out month by month. This is actually one of the best things to do. Not only is it going to help you get approved for the loan, but it's also going to help you do due diligence because look, there's over 3,000 franchises out there. And like, it's most people think of Jersey Mike subs and they think of Subway, but there's a lot of other franchises, a lot of home service franchises. And really to understand these businesses, the projections are one of the key, crucial due diligence part. The other thing, if you're not familiar with franchises, there's something called an FDD, which is a franchise disclosure document. And typically after you get introduced to a particular franchise and you have an initial call with them, they're going to send you via email an FDD. FDD is a 200 to 300 page document which indicates financial performance, if there's any litigation, really an A to Z coverage of like everything you might want to know on this particular franchise. And franchises are administered, sanctioned, I guess you would say, by the Federal Trade Commission. So the FTD kind of standardizes the way these franchises need to present their brands, their business models to you. Now, this isn't the end all be all for due diligence, but it's a good starting point to understand who the owners are, who the leadership, do they own any other franchise businesses, any previous litigation, there's something called an item 7, which is an itemization of low to high investment range. What is it going to cost for technology, working capital, and all that? And we take that when we're doing the financing, and that helps us build out the projections as well. So really, loan amounts under 500,000. So the SBA wanted to promote business ownership and promote smaller loans. So they had created something called a SBSS credit scoring model. So it's a more streamlined way to approve these loans quicker. And so you have to score, not only have your credit score really, doesn't play that big of a crucial role. Most banks set a standard credit score, 660, 680, but they're going to score you for loan amounts under 500,000 on this SBSS credit scoring system, which is 0 to 300. When you're looking at, if you guys have questions too, you can go in the Q&A. I don't like to talk this much. I like to answer questions too. But if you look at the loan application process, really works like this. Generally, we have a intake form. It's a couple questions. Then we like to schedule a discovery call. And generally, at that time, you're going to have an idea. You might be reviewing 2 or 3 different business models. So we're just going to talk in generals and at this time, because we're not going to have pooled and SBSS credit scoring. Our intake is, what's your credit score? What does your liquidity look like? What franchise model? We check to see if it's on the franchise, if it's an approved franchise. Does it have many locations, or is it, an emerging franchise has 1 or 2 locations? And from there, if you're not ready yet, we're going to, basically do a general assessment, and we'll know that the probability that, we're not going to have problems, or we need to take you to a particular lender because you have very low liquidity and you're not going to meet certain banks' guidelines. So that's how we help navigate the process, because not all banks are created equal, that's for sure. And not all banks really understand franchise startups. I will make a point here, is that there are banks and non-bank SBA lenders and credit unions that have a status called PLP, which means they're a preferred lender. When they're a preferred lender for the SBA 7A product, they underwrite in-house. We don't have to send it to SBA for approval. 504 is a little different. It's 2 underwriting processes. We're not really going to get into it that much, at least right now. And so now you have identified the franchise, you've done your homework, and you're like, yeah, I'm pretty much gonna move forward with this franchise. I'm finishing some due diligence. That's when you want to really hone in. So you want to have a general idea of what would I be pre-qualified for, and that really is an intake and a one initial discovery call. Some people it's pretty easy. Yeah, I've got 200 in liquid. I've got 800 credit score. I've got a job, right? W-2 job that supports all my outside expenses. I'm pretty golden. That's pretty simple because we know, hey, this person's got the 20% equity injection needed and he's got 10% post-close liquidity. Generally going to be an easy deal to get done, assuming that the franchise is an established brand. It's approved franchise, which generally most of what you'll be looking at would be an approved franchise. Now, granted, there's 300 or 400 new franchises that roll out every year. So some of them don't have many locations. And that's why initially part of our due diligence when we're doing the intake form is like, look, I don't have a franchise picked out, but I'm looking at this HVAC company. I'm looking at this, this dog grooming business. I'm looking at this business. So we have a general idea. Once you kind of finalize which brand, because we can easily tell which ones are, we've seen enough of the franchises where we can usually tell which ones are going to be that we've worked with before and have been approved and so forth. So once you now are getting close to signing a franchise agreement, then what's going to happen next is we're going to get all the documents. Generally, we went over that before. That's 3 years of your tax returns, financial statement, copy of your driver's license, business plan, projections, a couple other forms. And then we're going to do a sources and uses, which is basically like, franchise fee, 35 grand, working capital, 25,000, employee salary for the first 2 months. It itemizes the total cost of the project. When we talk about financing, when I say I can finance 80 to 90%, I'm talking about total cost. So I can build in working capital. And then what the banks really look at on a startup, right? All we can go is like, hey, it's an approved franchise. What do they actually look at? Because like, hey, I'm golden. They're looking at year 2 projections. And usually what they do is they stress test it by adding a one percentage to the rate. So if the going rate is say 10.5, they're going to say, okay, we're going to underwrite this at 11.5. And they want to see on projections that year 2 that you're profitable, right? So that's what we really have to do. So projections really can be fluffed, to be quite honest with you, right? Like the banks, they're going to go off general, like what do you pay this type of person? If like they know kind of generalization, they know what they've done in the past, but really there's a lot of fluff involved in it. And so you need to, not to tell you that you need to fluff it. What I'm telling you is that I tell people to spend a lot of time, especially if you're pursuing franchise startups, understanding the numbers. Like, for example, sometimes franchises in their item 7, which that's in the FDD, the franchise disclosure document, that's where they give you a low to high investment range. Well, sometimes they only build in 3 months of working capital, but if you have a business that takes longer to ramp up, you might need 8 or 9 months of working capital. So these are things that a good banker is going to help you, think about. And these are questions. And I should kind of interject. Who am I? I didn't do that. I didn't have that slide today, but my name's Beau Eckstein. I've been in lending for 26 years. And over the last 7 or 8 years, I got into SBA, and that's mostly what I do today. SBA lending. Through SBA lending, several years back, people were bringing me franchises to finance. And I would always ask them, why this franchise? And a lot of times they really didn't have a good explanation. And they had tried the pretzel at the mall and they liked the pretzel. And so then, maybe 4 years ago, I discovered that there's a whole industry. And so there's an industry, some people call them franchise brokers or franchise consultants. And anyways, I got trained and I started a company that helps people buy franchises. And so what early on, when I didn't know much about this business, I just thought people would just, pick them randomly. Like, oh, I like this. Hey, this crumble cookies. Everybody's getting the crumbles cookies, right? Like, and so there's a lot more of science and matching that I realized as I went through hours and hours and hours of training. To this day, 2 or 3 times a week, I'm on calls with different franchises. So I kind of have best of both worlds because I understand the financing and I understand the franchise buying process pretty well. Um, and and so really what I would recommend anybody to do is to look at a lot of franchises. And that's why you'd want to work with a franchise consultant. As a franchise consultant, like somebody like myself or somebody on my team, we actually don't charge you a fee for that. We get paid by the franchisor. So our job is to work with candidates like yourself. Our job is to really help you understand the process and then show you 7, 8, 9, 10, 12 different business models and then have you understand because a lot of people come into this thinking, hey, I want to buy a business and I'm thinking about this sexy business. But the reality is that if you listen to Cody Sanchez, she talks about boring businesses. The boring businesses, these service-based type of businesses, whether it's B2B or home service industries, generally they don't need a brick and mortar location. That's right. You don't have to get office space. You can run it from your house. Generally, you can have subcontractor workers or depending on the business model. So the startup and the overhead are much better and the profitability comes quicker in that case. So there's lots out there. So I've been doing SBA and franchise consulting, 26 years of lending. I've owned a real estate franchise. I own a business or 2 or 3 actually. And I'm always looking to get into more businesses because I like business. My background prior to that is all real estate lending. So I am a real estate investor. You know, I've done the house flipping, I've done the rental portfolio. But my new thesis today is after talking to thousands of people over the last 26 years, is that all these things have kind of flaws. And I think the perfect business model out there is what I call the triangle method. When you're a W-2 employee, and I have a lot of these people that are working tech or medical, and they crush it. They make 2, 3, 4, 5, 600,000 a year, but they have no tax write-offs. And part of what we do through the Business Ownership Summit is we bring on CPAs. We bring on Michael, who specializes in small business owners, and we educate people about like Section 179. There's really there's no better vehicle to get the best kind of tax write-offs without being deemed a real estate professional and meeting this eligibility of having X amount of time per year spent in real estate. And it's truly phenomenal because these people that are making, 500 or 600 grand a year and they're living in California and they have, $1 million mortgage and they have high taxes, they're having problems saving money. And so when you start opening your mind to like, oh, well, now I get it. Like not only is a business a good idea because this franchise that I start at some point is a sellable asset because I'm building equity and it's going to sell at a multiple of earnings in the future. I'm getting all these tax write-offs. I'm able to set up self-directed retirement accounts. I can defer income through those channels, and then I can use Section 179, and I can increase cash flow and take that extra cash flow and buy real estate. So I think that what I call the triangle method is tax strategy, operating business like a franchise or any kind of business, and real estate, right? Because when I started out, I thought, oh, I was going to get all these rental properties, but the reality of it was it was getting hard to buy local because when I lived in California, everything was so expensive, and to save up a down payment, and the thing never cash flowed. Sure, I could make appreciation over time, but it wasn't a very sustainable model. Versus maybe you have a good W-2 income, now you have a business, now you have the tax write-off, you have extra cash flow, and now you're able to buy that 1 or 2 rental properties every year. You're not really relying on that cash flow. Over time, the equity goes up, the renter pays off the mortgage. So that's the kind of strategy I think we should all look at, because I think that will get us to, our financial independence number quicker. And that's kind of like the triangle method. But going back to the SBA loan application process, once you identify the franchise, then we start, what are the total project costs? You got to hone in the numbers, the projections. There's a little bit of hand holding on our team's part when we're trying to get you to to get you all the initial submission documents. Once we get the submission documents, prior to you signing the franchise agreement and paying a franchise fee, we're going to get you pre-approved through one of our bank partners. And then from there, once you sign the franchise agreement, you have kind of, you generally have an idea that you're approved, subject to getting a loan commitment. Then you're going to get the rest of the documents to the bank. And from that point on, the bank usually takes over. I sit in the background, or my team sits in the background. So really, we help you on the front end. On the SBA side, 95% of the banks, we don't charge a fee. They pay us referral fees or consulting fees between these banks, because they want us to bring qualified deals, and we know how to put the packages together. One or two banks we work with, we charge a packaging fee because they don't pay us any fees. Just to kind of tell you how this process works on working with us. But generally, most of the times, the banks pay our the fees. The beautiful thing too is, let's say you got into this painting franchise and you put down 20% of the cost of the 200,000, so you put down 40,000. Now you've owned it for a year or two, and your tax returns are solid. You can actually get up to 100% expansion financing on further ventures within this painting business. You can have up to $5 million of aggregate SBA 7A. That hasn't changed in 20 years. I think that number will go up. Now, obviously, with the 504 loan, you could do real estate deals and up to like $22 million because it's a first and second. But with the 7A loan, it's generally $5 million you're capped at. You can have multiple SBA loans too. That's another beautiful thing. So I can have 5 or 6 different SBA loans with that. And so some of our bank partners, they also do interest only. So if you're doing a franchise startup, you're not making money the first month, right? You might get 1 or 2 sales or whatever the service you're doing. So they do interest only for the first 9 months. And then some of our banks, on top of building and working capital in the primary loan, they'll actually give you a revolving line of credit up to 20% of the total project cost. And that you only pay interest on what's dispersed. So that is pretty good too, because at some point, let's say you was a service-based business and you needed a van, and now you're busy, and now you want to buy a van too. Now you have this line of credit you can use as the down payment, perhaps enough to pay for the van or the machinery you use. And then now you file a good year of tax returns, and now you want to buy another location. You potentially could get up to 100% financing on expansion. So you can own multiple territories. Now, if you buy a different franchise, not in the same, what's called NAICS code. A NAICS code is just a classification system that they use to, for different business sectors. So if it's the same business sector, same industry, same franchise type of thing, you can get 100% financing on expansion. But if you want to invest in another franchise that was you own a painting company, now you want to own a flooring company, that's a different NAICS code. That would be construed as a startup. If you're looking at a couple different franchises, you should what I would recommend is that you go to, I should have put this in the notes, but you go to franlending.com/meet. And that's if you go there, franlending.com/meet, I ask you a couple questions, and then it gives you a calendar link to book a discovery call. Book a discovery call because I just want to, I think there's a certain kind of conversational aspect of okay, what are the brands? I call franchise brands. What are the brands you're looking at? I see, and then that questionnaire, which takes you about 2 minutes to complete, will give me a little bit of foundation. And then I can set you on the right track of the next process, because it's a little different depending on what type of franchise you're looking at. Are you doing a brick and mortar location? Because there's a little bit more steps. Are we going to if you're doing brick and mortar and you're doing TI, which is tenant improvements, different, right? Then I'm buying a home service business, no brick and mortar. So that discovery call is really important to kind of set the stone. We can generally, pre-qualify you at that point. And then when you start narrowing it down, you're like, okay, I'm pretty sure I'm going to invest in this painting company. Then I gather enough, and then I get you a pre-approval from the bank. And then from there, you sign that pre-approval, and then we gather the rest of the documents and we submit for a loan commitment. When it's a non-franchise startup, there's more weight that's going to be put on the business plan. that you do. But the business plans, don't get too scared. I mean, with AI and everything, I have a template. I have a few templates, and I've just played around with it, and I'm able to kind of prompt ChatGPT, and you can actually get a rough business plan done fairly quickly. Now, there's certain things that you'd want to know, like when you need to build out your projections. I think that's another talent that we have. We're going to prep you on like, okay, like when you're calling other franchise owners, these are the questions you want to ask them. Like, okay, if it's a painting company? I'm just using a painting company. What every time you paint, what's your average ticket? Like, okay, every time you win a quote and you paint the house, what does that number look like? What's the average? Okay, it's $4,844. Perfect. And then, all right, like that's going to help us. How many like build the projections? So I think that's like a key component of all that. So going back to that, I kind of went off track there. The business plan is put it this way. I did this year we did a laundromat non-franchise. Guy had no experience, didn't own a real estate. It was 1.2 million total startup cost. We were able to finance 85% of the startup cost. Business plan are key, projections, and then overall like credit worthiness of the borrower. What's their resume and that kind of thing. But yeah, all day long. In general, you're going to get lower loan to cost. So, some banks on startups are like, for example, Huntington Bank on a startup is at 70%. That's non-franchise. Other banks are able, like I just did, 85. Some banks can even do 90. But it's also what industry, who the borrower is there additional collateral and all those things. But yes, it's all fundable. It's just you gotta position the package correctly and get it to the right bank. Because I took that laundromat, I had four conversations. The fourth bank, I don't submit to four banks, but I have conversations. So sometimes it takes a little elbow grease from us to get you the right fit because the banks are different across the board. That's what we really help you do: navigate the deal and get it done. If it's a startup, non-franchise, I would just say go to bookwithbeau.com and click on SBA discovery call. Bookwithbeau.com. We'll send out an email too, but bookwithbeau, BEAU.com and book. I'm actually the funny thing is I'm in the process. I haven't volunteered in a while, so I'm in the process of being a score mentor actually here in Las Vegas. And I'm doing co-mentoring right now. But I actually wanted to do more of the presentations, but it's going to be fun. So the cool thing is that I was talking to one of my bankers the other day, and I have this guy that's doing a startup, and it's a brick and mortar. He's like doing it with the real estate. It's a candy business actually, and I've never done a candy business, but I can figure out how to do anything. I mean, they're all the same, really. And his business plan, I knew it was a little weak. Sorry if you're listening, but the interesting thing is the bankers I work with, we call them BDOs, business development officers. So the BDO I'm working with, he's actually the guy that helped me do the laundromat. I knew his bank would be a good fit because it's just such a random business. Like if people don't understand it, like, and so they're interested, but he said, hey, the business plan is a little repetitive. And he said, our bank really likes this business plan. And it was actually a score template. So the moral of the story is the score template, I should link to it and send it out, or just reach out to me and I'll get you the right template. But anyways, a template like that. And then, and I'm not like I don't like putting together business plans. I like to like gather the information quickly, and then I figure out how to use AI like ChatGPT effectively. And actually, if you understand prompts and like the questions, the inputs you need to add, you can put together a business plan really quick with ChatGPT. And so Bill, who you don't see, he's he's like my MacGyver. He's a marketing guy. We've worked together for 12 years, but we use AI all the time. And so like I'm working on some like templates with Bill to make it easier, because even when you get the score template, it is kind of overwhelming still. And look, score mentors to put together business plans, it's free. And so take advantage of all that for you guys, if you're doing it, especially if you're doing a startup. because they'll help you, and they're really smart people over there. Uh, and It's interesting too. I'll just tell a quick feedback. So when you when you volunteer to become a score mentor, obviously they do like a pre-screen. Then they want you to do a certain amount of co-mentoring sessions. So I was on my last co-mentoring session, and I was doing it with this lady, who's been a mentor for a while, and three people didn't show up for appointments. And I was like kind of blown away. It's like, look, it's a free service, and probably because it's free, people take it like, but look, like it's really good. And it kind of shocked me that so many people like scheduled a call and never showed up, and like don't take advantage of like what we have available to us. I mean, there's really a lot at our fingertips. I mean, like for example, like today, like I'm hopefully providing a little bit of value to you guys. I'm not charging you anything. Sure, hey, it would be nice if I got your business in the future or sooner than later, but there's a lot of resources out there for all of us, and so like and like we should all take advantage of it. So I hope that kind of gives you a little feedback. Like Score, and there's some other organizations that are really good. You can learn a lot, and even though I'm pretty good at SBA financing, I learn something new all the time. And there's a lot of programs out, which this isn't my specialty, but there's a lot of grants and things. So, if you're maybe don't have much capital and you're a little stuck and you have a really good startup idea, maybe there's some kind of program out there for you. And that's where like a place like Score might be able to help you and point you in the right direction. I'm not good at that. I'll just tell you that. My focus is, SBA and structuring deals and figuring that out. I don't know the grant side. Now, since I'm going to be a mentor there, maybe I'll learn some more resources, and because I'm definitely interested in trying to help more people. Right, we have a mission to help 10,000 aspiring entrepreneurs become successful owners over the next 10 years. But I changed that to 100,000 because it doesn't have to be one-on-one, and I do webinars a lot, and I also have a podcast, and so we've had close to 2 million views on our YouTube channel. So I would say that we're definitely going to hit that number over the next 10 years. And so that's why we like doing this stuff, and it's fun. And at the end of the day, I also think like, uh, there might be one person on that ends up buying a business and it changes their life, whether we help them or not, indirectly because they're here. We're obviously helping them in a certain way. But yeah, that's really the goal, is to help people. Some people are feeling a little bit stuck in life, and like they're doing okay financially. They're making 100 grand, but they live in a high cost area, and they're really not getting ahead. And then they're in their mid 40s, and they're like, well, what the heck? I gotta think about my future. And so there's really no better time. And I think the reason I like franchises, because you don't have to like go out and find like a business acquisition and it's like a needle in a haystack. There's like a lot of franchises, and you can really spend your time, and you can like find something that really works well. The business model flows. It's generally, you're not paying a multiple of earnings because you're just paying startup costs. Um, Either that, or if you have a great idea, like I think it was Melissa, and she's doing a startup, that's also fantastic, right? Like so, um, you know, what I would say on startup, on franchise stuff is, you know, a lot of the component is like what they're looking for is that your outside income supports your outside debts. You have good credit. You have a great business plan. Your projections make sense. And you have enough for the equity injection, where some banks might be at 70 to 85% loan to cost as opposed to 90. Generally, let's just say 70 to 75 to 80-ish. 75 to 85 is the range probably for a startup for most banks. Then yeah, you can definitely do that too. So you just got to keep the general thresholds. Like, after I put my down payment, do I have 10% post close liquidity? Post close liquidity is based on the total project cost. So, the total project cost is 300,000. After you put your down payment, you have 30 grand left over in reserves. Now, you can get a family member to give you a gift. You can get gift funds for your equity injection. You can bring in a minority partner that owns 20% or less, and they could own part of the business, but not have to be a guarantor. SBA loans are, you do sign a PG, which is a personal guarantee, just like any, like when I take a credit card out, I'm guaranteeing that loan, right? So so common challenges and solutions, obviously low credit scores. You know, there's something called the Community Advantage Program. They have a little bit higher rates as far as the margins. They're not as credit score driven, so depending on the deal, sometimes deals have to go through them to make the deals. That's generally for like smaller type deals. Generally, that's like if it doesn't work elsewhere, it would be a Community Advantage Program. That would be for somebody with like, you know, poor credit scores. As far as insufficient collateral, you don't need collateral. Loan amounts under 500,000, they're not looking for additional collateral. It's a guideline. Loan amounts over 500,000, if there's a collateral shortfall, they're going to look for additional collateral. Doesn't mean they won't do the loan, but if you have it, they will put a secondary lien on a primary residence or rental properties. And then look, every loan is a little different. Every deal is different. And I think every bank has completely different guidelines. I didn't really specialize in that we have a program called the SBA Express, but it's really just a small SBA. But they actually just pushed out a program a year and a half, 2 years ago, where they'll do, even if a business isn't cash flowing. So if you've owned a business for over and you have 2 years of filed tax returns, even if you're making revenue but your tax returns show losses and you have good credit, you can get an SBA Express working capital loan of 150 grand in 2 to 3 weeks. I just happen to meet, and I'm going to do a partnership with these guys. They have done 125 million in funding of these $100,000 to $150,000 loans, closed 2 to 3 weeks. So that opened my eyes, just because I'm like, I study SBA and I'm like, wow, I didn't even know that you could have non-profitable businesses. Now, it doesn't mean they have to be generating revenue, but on their tax returns, they're losing. Maybe they have a lot of startup costs that they're doing. Generally, you need 660 or better credit score. They're going to use an SBSS type of credit scoring model. You still need to provide your financials, but you know, they're pushing these deals out. I don't know how long that product's going to stay around. I think it's going to depend. This was a big government push to help, you know, smaller business owners succeed, because a lot of times what happens is businesses, 38%, or give or take, I'm just pulling that number from somewhere, but I can't cite it, go out of business because they're not capitalized. And so that's part of what we do in our planning process, is really, what is the ramp up of this particular franchise or not startup? Like, let's make sure we're not like really excited and we're going to go, hey, 3 months, and then 3 months come around and now we have no capital. So we got to think about building enough working capital in the deal. So I think the government figured out, hey, this is where we need to help, is the small ticket, these, you know, smaller businesses. And so you're seeing a lot of movement in that section. We're still doing a lot of big SBA loans, $5 million deals, $8 million deals, people buying large, doing large business acquisitions. So, you know, after listening to the small business trends, I see nothing but more of this happening. More people are like, look, maybe I'm not ready to invest in a franchise. Maybe I'm not ready to do like a full, you know, startup type of business, but what kind of side hustle or gigs can I get into? And we're seeing so much of that. And I don't blame. I mean, I'm always looking for opportunities. It's like, I think I just had a child, my first child, at 46 years old. And I waited a long time in life. And the thing I really want to, you know, hope, you know, obviously I was hoping that he was born and he was healthy. But thinking about like what I wanted, my son's also named Beau. And so he's baby Beau. So what do I want baby Beau to really take home? What do I want him to learn from me? Obviously, love, compassion, treat people really good, and how you want them to treat people, how you'd want them to treat you, right? Like, open doors for people, show people respect. But I wanted him or Beau when he's, when he's in high school, when he's younger, when he's in elementary school, start teaching him about business. He can get so much further ahead. I was thinking, geez, how cool would it be in high school if he had a vending business and he had 10 or 15 machines and he was making 8, 9, 10 grand a month or whatever that number is. And like he could cover all of his living expenses. Then when he graduated high school, he might say, hey, I'm ready to start another business. Or, hey, maybe I do want to go to university because I want to be a doctor or a lawyer somewhere. I need the school. Or maybe I want to go into trade school. But I think that's so important. And so I'm glad I waited in life because I think I'll be able to, through all the learning I do. I didn't go to college. I tried to. I just wasn't a good student. But then I discovered once I started learning about something I was interested in, I was actually a good student. And so I spent the last 26 years learning all different, useful things in real estate, investing, financing, business, tax. That's my new thing is like tax strategy. I'm not a CPA or a tax attorney, but like, I just think from a high level standpoint, if 40% of our earnings are going to taxes and there's ways to defer or potentially eliminate part of that taxable consequence, like instead of making more money, can we fix that problem first legally using tax strategy? So I think a lot of us don't look at things like that. So I think looking at that and just saying, okay, baby Beau, like I want to give you the best start in life that I might not have thought about. And I have great parents. But I think every generation of family should try to get their children, a little bit further ahead. And I think that, teaching kids the value of business and working hard. And not to mention now we're coming into a new world with AI. I mean, it blows my mind. Some people haven't even played around on some of these AI tools. Bill and I, it's kind of our we do a lot of things with AI. I mean, I write scripts and I write, helps me with content ideas for my podcast, emails, marketing letters. It builds spreadsheets. It can do a lot of things for you. It actually, I was just showing somebody earlier today. I gave this, I uploaded a document to something called InVideo, and it took my voice, read the script in my voice, and put together a whole 5-minute video. Not with me in it, but just like scenes and things. So technology is definitely changing. So I think that's going to create a lot of opportunities. A lot of jobs will be gone, but there'll be far more created in this whole new world. I mean, right now, there's high-paying jobs for what they call prompt engineers. And prompting is when you basically give AI technology inputs so it can give you better outputs. And so that's like a whole new industry that's just blowing up. So even though I'm not really a techie person, like Bill's a lot more techie than I am, like I understand the strategies high level, like how do I utilize this? And so it'll be interesting how we can, that's where like before you would need to have like a team of like 30 people. Well, now people are starting to understand virtual assistants. Like I have 3 assistants team members that are in the Philippines. They're going to edit this video. They're going to do other stuff for me. I use AI and all this stuff together. So I think understanding these trends and like what business models make sense for you. And then like, do you want a brick and mortar location? Do you want a remote business? Do you want a semi-absentee business? And then understanding the financing and putting all these pieces together will really kind of get you along. But yeah, at the end of the day, I guess I'd say, because we're running up on time, is that SBA financing is really a game changer. It's an amazing product. Most, sometimes I work with candidates that are looking for franchises in Canada. They don't have an SBA product, right? We're very fortunate. And now with this express loan, even if some of these businesses aren't profitable, they can still go and get $150,000 working capital to help them, break through the kind of the trajectory and get to where they need to be to grow. For somebody that's going from corporate to get 90% financing on a franchise startup, I mean, this is really game-changing stuff here. And if you keep your credit good and understand credit, the other thing I'll just kind of wrap up on is guys, keep your credit good. Like, understand utilization. So many people never miss payments, but they charge up they have a credit card where the high limit is 10 grand. They're at 9 grand. Their score goes from 700 down to a 550. Now they can't get any good loan product. Where if you had a business entity like an LLC and then you got a credit card in that name, it doesn't necessarily show up in your personal credit report. So you got to learn the credit game too, I believe, guys, especially when you're getting businesses and like, because when you have a business, you're going to like buy trucks and you're going to do all this stuff. So you really have to need high level of how this all works. So you don't get stuck with high credit card debt in your personal name, because that's really going to kind of impede your growth. Keeping your credit good, your personal profile really strong, then you leverage the financing. So we only like good debt, not bad debt. Good debt is like an SBA loan because you're buying a business and you're going to make a bunch of cash flow. Not that, bad debt is I'm buying this this Porsche because it's freaking awesome, and I'm really stretching myself, but I really want the Porsche because I want to cruise it. Like, hey, that's great, but do that later in life when that $2,000 a month payment won't be such a burden. And right now, let's focus on just good debts. Now, if you're using that Porsche for Toro and you're crushing it and making a return on it, that might be a different idea. But anyway, client profile, first-time franchisee with 10 years of restaurant management experience. Loan details, $500,000. Loan for popular fast casual franchise. Key success factors. So there's certain industries like restaurants, which are high risk. So the fact that this franchisee had 10 years of experience in restaurant management makes banks feel more comfortable. Now, when we're looking at startups, here's a big thing to point out. Somebody who has no restaurant experience and is doing a non-franchise startup, that's a lot more high risk than somebody that doesn't have experience but buying into a franchise QSR or quick serve restaurant, right? Like, the franchise is actually probably pretty easy, where the restaurant startup, especially if the borrower is a little weak financially, can be more challenging. You see how it all works? I'm trying to point those things out. And that's really kind of setting the expectations. There's certain industries that have a little bit higher risk factors, like hospitality, like hotels and motels, the restaurant industries. Some of these sectors have a high default rate within SBA, restaurants being one of them. But this outcome was fairly simple because the candidate was buying into a successful franchise restaurant. The candidate had 10 years of restaurant experience, had a good business plan, credit, experience, and had all the success characteristics. Now, the difference would be, what would make this deal more challenging would be that the person had no experience and they were doing a franchise startup and they were marginal credit and didn't have a lot of reserves or post-close liquidity. This is kind of an avatar deal. Like, this thing's going to move pretty quickly. So just knowing the variables of what you're trying to do, like I believe her name was Michelle. She has some sort of startup. So what is the industry? How does your experience correlate too? Is important, especially on a non-franchise startup. Like franchise it's interesting because SBA's kind of view on it is, look, this franchise has 200 locations. For example, we have an HVAC franchise we work with. The last 30 candidates that became franchise owners, 27 of them had no industry experience. They were all entrepreneurs. So the difference between a franchise and a startup non-franchise is that you're buying into a system and blueprint. So the SBA loans are a little bit easier to get. Does that make sense? So I like any challenges. We can do startups all day long. I'm just want to kind of just paint the picture of how this all comes together. And certain banks would say, heck no. So certain banks out there would say, non-franchise restaurant, I don't care who it is, we're not doing that type of deal. So they're picky like that. I have one bank that I work with where they're really aggressive on deals they like. Certain industries, the credit manager says, nope, we won't look at any of those deals. And then some banks look at any type of deal. So it's just, that's how we have to navigate, and we have to find that right bank. That's what we do internally, is we are constantly going to events with these bankers. We're, talking to them regularly. I'm friends with an SBA recruiter who has recruited most of the bankers throughout the last 30 years. And so, when I have a tough deal, I give Mike a call. I go, Mike, look, hey, I'm having trouble on this type of deal. Who do you know in these markets? And so those are the strategies I use to help me, win. And winning means getting you the financing, depending. But all in all, financing, if you're a strong borrower, it's fairly easy. A lot of people say SBA is so challenging. It's really not. It's just certain business models and certain things that you're trying to do are a little bit more challenging. But if it's a cookie cutter deal, it's really easy. Obviously, there's a lot of paperwork, but this is just kind of one example here.
What is the average processing time for an SBA loan application from pre-qualification to disbursement?
It's bank specific. Generally, most banks on a franchise startup, for example, are going to be about 60-ish days. But I have a bank that I work with for certain franchises, and I close deals with them in 3 weeks. So anywhere from 3 weeks to 60 days. But I would say most of the banks are going to be around 60 days. And it's also a component of how fast you get the information back, the projections, business plan, right? Franchise agreement, or if you're doing a business acquisition, you got to get stuff back from the seller. But generally 60 days with no real estate, 3 weeks to 60 days, depending on the business or what it is.
Okay, last one will be, what are the potential drawbacks or risks associated with SBA financing that potential franchisees should be aware of?
The risks are that if the loan amount's over 500,000 and there's a collateral shortfall and you have real estate holdings, they would put a lien on or part of the requirement to get the deal done, and it's an SBA guideline, loan amounts over 500,000, and there's a collateral shortfall, that they have to look for additional collateral. So if you do have that collateral, then you would get a secondary lien, which isn't the end of the world, is if you know what's going on. Some people are really smart, and they go and get equity lines of credit on their house way before they apply, so there's not as much equity. That's not a bad idea, but not everybody does that. But that would be one con, I would say, if you had the real estate and the loan amount was over 500,000. The other thing is if you happen to default on federal debt, you'll never get federal debt again unless they change guidelines. So I have people down in the 2007 downturn, they filed a BK, which eliminated a federal loan they had, and they can't get SBA loan until they change it. They might change that guideline eventually, but that was a long time ago, and the guys recovered. So you never want to default on federal debt. It's a tedious process regardless. It's a lot of paperwork. It's not that hard, but some people just, can't stand paperwork. So, and putting together projections on a startup, some people hate that. But you can always go to SCORE, or perhaps I can help you a bit. The pros far outweigh. Look, this is the way to get. We did a deal. Just to give you an example, we did a deal. I arranged the financing. The guy had just bought a short-term rental and used all his cash, and he wanted to buy this marina with land, and it had a restaurant. And so he had no cash. He made good income. He had some other holdings, business holdings, but he had no liquidity. He was able to get the seller to carry a small amount back, but he still needed about 140 grand. He got his brother to put up 40. He needed 100 grand. So I was able to find 2 investors. And so he came in with no money. And now his brother and the 2 investors all own under 20% each of this business. And then, this guy was happy because now he owns 50% of the business, and everybody kind of wins, right? Because he's still taking the risk, because if you own less than 20%, you don't have to be a guarantor. If you own more, you're going to guarantee the loan. So he's guaranteeing it. So you can be extremely creative. So, I personally would look for deals like that as an investor. Like, hey, somebody's or a family member, or perhaps you have a child, or perhaps you're younger, or perhaps your family members want to invest in your deal and they don't want to take the risk. They're willing to risk the 50 grand or whatever. So you can be really creative as well. And so you can do no money down deals. I mean, it's not like you still want to fit all the other criteria, but is it possible? Yes. Next steps and resources. Let's try to wrap this up. Here's the thing. If you're looking at franchises already or businesses, happy to work on the financing. You can go to Fran Lending. If you're like just starting out and you'd want our team to help you identify a franchise to potentially invest, you can go to, if you want to look at franchises and have our team help you, you can go to businessownershipcoach.com/quiz. Bill and I built a quiz for business ownership readiness. It's like 30 questions. And it'll send you your results back. It'll send you a link, and then it actually sends us the results. And then it will send you in that email, it'll send you a link to book a discovery call. So if you're interested, take the quiz and then book the discovery call, and then we can, take the next steps. The next steps just a general conversation, which outlines how we can help you and like answer any questions. For the financing side, you can go to bookwithbeau.com and then click on SBA, and it'll pull up our calendar to meet for an SBA discovery call. If you have a deal in process, there's a certain calendar. If it's just general questions, you can have another calendar. So we can help you across the board. Just let us know how we can help you. We have a small but very good team. We have 2 franchise consultants beside myself on my team. So generally you might work with me, or perhaps somebody that's a little bit even better at helping you match than I am. I'm pretty good, but so we have a really good team there. We're strong on the SBA side. We have great banking relationships. And that's really how we help. And then we do events. And so go to businessownershipcoach.com/quiz if you want to look into franchises, and we can explain. There's a lot more to the franchise process. We've done webinars on it, like the franchise buying process, how you do due diligence and all that fun stuff. And what else is there? Businessownership.com or businessownershipsummit.com if you want to go to the event on October 5th. And if you want to see other events that we do that are on Eventbrite, you can just go to my name, which is Beau Eckstein.com/events. And that lists all the, we do different webinars. Like tomorrow, Bill and I are doing one on how we utilize, we're presenting, because I have a real estate background too. We're presenting on to mostly real estate agents on how to utilize virtual assistants and AI to, be more productive essentially. So if that interests you, feel free to jump in tomorrow. But October 5th for sure, Business Ownership Summit, which is also at boeckstein.com/events. Other than that, I've talked my ear off, and I hope you guys enjoyed. And please, we'll send a recap out. We'll send this replay, and then we'll send a link out of all the resources we just mentioned. Other than that, have a great evening. Thanks for spending the last hour with me. I hope I provided some value for you. Hi guys, Beau Eckstein here, and I'm with baby Beau. Baby Beau is just a little over 4 months. He's my first child, my wife and I. So if you want to create legacy for your family, I highly suggest you go to our Business Ownership Summit. You can find all the events we're doing. Primarily, they're all free. You can go to boeckstein.com/events. And I hope to see you at one of our events where we teach business ownership, how to leverage SBA financing, tax strategies. I'm not a CPA or attorney, but we bring CPAs on. You're going to learn why everyone should own a small business. So I hope you attend. Go to boeckstein.com/events. I'll see you at the next one. Hey guys, Beau Eckstein here. If you enjoyed what you saw, please subscribe to this channel. We talk all things financing. I've been in the lending industry for over 20 years, and I'm happy to answer your questions and provide great content.